Have you ever felt like the stock market is this mysterious place where people either make a fortune or lose everything overnight? You're not alone. Surveys show that more than half of adults want to invest but avoid it because they find the stock market confusing or intimidating. The truth is, the stock market isn't as complicated as it seems. And once you understand the basics, you can use it to grow your wealth steadily over time. In this video, we'll break down the essentials of the stock market in a simple, beginner-friendly way, so by the end, you'll have the confidence to start your investing journey. The first thing to understand is what the stock market actually is. At its core, it's a marketplace where people buy and sell ownership in companies. When you buy a share of stock, you're purchasing a small piece of that company. For example, if you own one share of Apple, you literally own a tiny part of Apple. If the company grows and becomes more profitable, your share becomes more valuable. If it struggles, the value of your share can go down. It's no different than owning part of a small business, except that here you're investing in some of the biggest companies in the world. Imagine being part owner of companies like Disney, Starbucks, or Nike by buying their stock. You benefit when they succeed. Now, let's talk about how people make money in the stock market. There are two main ways: capital gains and dividends. Capital gains happen when you buy a stock at one price and sell it later at a higher price. For example, if you bought Amazon stock years ago at $100 and sold it at $3,000, that profit is your capital gain. The second way is through dividends, which are payments companies make to shareholders as a way of sharing their profits. Not all companies pay dividends, but many established ones, like Coca-Cola or Johnson & Johnson, do. This means you can earn money just by holding onto their shares, even without selling them. A lot of wealthy investors actually live off dividends because they create a steady stream of income, almost like collecting rent from a property. The third important concept is stock exchanges, which are the platforms where stocks are traded. In the US, the two biggest are the New York Stock Exchange and the NASDAQ. Think of these exchanges like giant marketplaces where buyers and sellers meet. You don't go to these exchanges yourself. Instead, you use a broker like Fidelity, Robinhood, or Charles Schwab that gives you access to these markets through an app or website. Your broker is essentially the middleman that connects you to the stock market. In the past, you would have needed to call a broker on the phone to place a trade. But now, it takes just a few taps on your phone to buy a share of Tesla or Apple. This accessibility is one reason more people than ever are investing today. Next, you need to understand the difference between individual stocks and funds. Individual stocks mean you're buying ownership in a single company like Tesla or Microsoft. Funds, on the other hand, are collections of many stocks grouped together, usually managed by professionals or built around an index like the S&P 500. The S&P 500, for example, tracks 500 of the largest US companies. When you buy an index fund or an exchange-traded fund, ETF, you're buying tiny pieces of all those companies at once. If you put $100 into an S&P 500 ETF, that money is spread across household names like Apple, Google, JP Morgan Chase, and hundreds of others. The advantage of funds is diversification. They spread your risk across many companies instead of relying on just one. This leads to one of the most important rules of the stock market: diversification. Imagine putting all your money into one stock, like a single airline. If that airline goes bankrupt, you lose everything. But if you spread your money across dozens or hundreds of companies, the failure of one won't destroy your portfolio. This is why beginners are often encouraged to start with index funds or ETFs. Warren Buffett himself has said that most investors would be better off simply putting their money into a low-cost S&P 500 index fund rather than picking individual stocks. To put this into perspective, if you had invested just $1,000 in the S&P 500 back in 1980 and left it alone, by now it would be worth well over $100,000, even accounting for all the market crashes along the way. Another essential concept is risk versus reward. Every investment carries some level of risk, And generally, the higher the potential reward, the higher the risk. Stocks can fluctuate daily, sometimes dramatically. For instance, a company's stock might drop 10% in 1 week due to bad news, then rise 20% the next because of a positive earnings report. The key for beginners is to avoid panicking over short-term movements and instead focus on long-term growth. Historically, the US stock market has returned about 7 to 10% annually over the long run, which is far better than simply leaving money in a savings account earning 1 or 2%. It's normal to see your portfolio dip during recessions or crashes, but history shows that over decades, the market recovers and grows. Now, let's go over bull markets and bear markets, 2 terms you'll hear often. A bull market is when stock prices are rising, optimism is high, and investors are confident. A bear market is when stock prices are falling, pessimism is strong, and fear takes over. These cycles are normal. Over the last century, the stock market has gone through dozens of bull and bear markets, but in the long run, it has always trended upward. For example, after the 2008 financial crisis, the market fell nearly 50%, but within a few years, it had not only recovered, but reached new all-time highs. Investors who stayed in the market during that downturn were rewarded, while those who sold out of fear often missed the recovery. The 7th key point is how to actually start investing. For beginners, the process is straightforward. Step 1. Choose a reliable brokerage platform. Step 2. Decide whether you want to buy individual stocks, funds, or a combination. Step 3. Set up automatic contributions so you're consistently investing over time. This strategy, called dollar cost averaging, means you invest a fixed amount regularly, regardless of market ups and downs. Over time, this smooths out your costs and helps you avoid the stress of trying to time the market. For instance, if you invest $200 every month into an index fund, sometimes you'll buy shares when prices are high, and sometimes when they're low. Over the years, these ups and downs average out, giving you a steady growth curve. Another thing beginners often overlook is the importance of fees. Some brokers or funds charge high fees, which eat into your returns. That's why low-cost index funds and commission-free trading platforms have become so popular. For example, if a fund charges a 1% annual fee, it might not seem like much, but over 30 years, it can reduce your total returns by tens of thousands of dollars. Compare that to a low-cost fund with a fee of 0.05%, and the difference over time is staggering. Keeping your costs low is one of the easiest ways to maximize your long-term wealth. It's also helpful to understand the role of emotions in investing. Many beginners panic when their portfolio drops in value, but successful investors stay calm and focused on the big picture. The truth is, volatility is part of the game. Markets will go up, markets will go down, but history shows that patient investors who stay the course come out ahead. One common saying in investing is time in the market beats timing the market. In other words, it's more important to stay invested consistently than to try and guess the perfect moments to buy and sell. Finally, let's talk about the right mindset for stock market success. The wealthy don't treat investing like a lottery ticket. They know it's a long-term game. They accept short-term volatility and stay focused on consistent growth over decades, not days. For beginners, this means avoiding emotional decisions, not chasing hot stocks, and resisting the urge to constantly check your portfolio. A disciplined investor builds wealth patiently by staying invested and letting compounding work its magic. To illustrate, if you invest $300 a month in a fund that grows at 8% annually, after 30 years, you'd have around $400,000 even if you never increased your contributions. That's the power of long-term consistency. The stock market isn't a mystery reserved for Wall Street insiders. It's simply a place where everyday people can participate in the growth of companies and the economy. By understanding the basics: what stocks are, how money is made, the role of diversification, the importance of low fees, and the mindset needed for success, You're already ahead of most people who never take the time to learn. If you want to continue building your knowledge and learn practical strategies to grow your wealth through investing, make sure to subscribe to the channel and turn on notifications. Every week, we break down financial topics in a clear, beginner-friendly way to help you take control of your money and future. Don't let fear keep you out of the stock market. Choose knowledge to step in with confidence.